Can everyone see this? Perfect. All right. Well, MA, Purdy, thank you so much for inviting me. And to the rest of you, it's really an honor to be with you. I don't know why I, as a white, balding, older man, got invited. But you know, I'm here to try and get myself out of a job so that next year it is one of you kind of doing the session on the numbers. My mission for this session is to give you a little bit of comfort around how to look at the numbers, how to project forward your business model. And I'm going to try and pitch it at a sort of level where I'm going to cover the basics. But if you have kind of harder questions as we go along, jump in. So by the end of this session, kind of my aim is to give you three things. One is how investors are going to look at the financials that you're presenting. What is your business model and how are you fundraising around that? Two, what are your basic building blocks? I really want to drive this point home, that I want to try and give you an idea of the kind of things that the investors are going to be looking at and that you need to be fluent in. So unit economics, break even, cost of, the customer acquisition costs. And then we're going to go into some different examples. And I'm going to try and do this over about 20 minutes. I'm going to go super fast over the sort of things I want to cover. And then I want to open the floor up to questions, because each of you is going to have different business models and different ways of looking at things. So we'll try and get into some of the specifics. So talking to investors, I think, can feel a little bit like this at the beginning. I don't know if the Giphy works. I hope so. But I'm going to try and get you to a point where instead you're gonna tame the numbers, and you're gonna get to a point where you're comfortable conversing with your investors on the basic numbers. So diving straight in, how are investors going to look at your numbers? So all of you are going to be, if you're fundraising, going to be going through kind of this process over the next few weeks and months. So you're going to be sending out, you're going to be kind of reaching out to investors. With that, you're going to have some kind of a short intro maybe. Then they're going to ask you to send a deck. That might be a sort of 10-page thing. You might then get invited to present in a 30-minute, usually a 30-minute call with probably a young analyst who is going to, pepper you with a lot of questions. And then you're going to, if you get through that, you're probably going to have another call, let's say an hour or so with some of the partners, maybe one or two more, and then you're really engaged with them, and you might get a term sheet. Now, every step of this way, you are going to need to understand the basic numbers. But basically at seed stage, pre-seed, angel stage, or even round A stage, basically your numbers are assumptions that you're validating as you go along. So you need to be presenting as sort of validated numbers as you can, and no one is expecting you to build a fancy financial model that has all the correct numbers, because that's what happens when you're at 10 million, 20, 30, 50, 100 million in revenue. Right now, it's about understanding your financials to get to the next milestone. So what do I mean by milestone? Well, Anthony earlier was talking about kind of your valuation at different stages. I'm going to give you, this is an example of a company that we've been looking at that has been, has done several rounds so far. And these are the kind of milestones they're at. So pre-seed, they're at pre-revenue and pre-product. They had 0 revenue. And the milestone they wanted to hit with the first money they raised was 150K in revenue. That's the milestone they hit. And they raised 200K to build a product and do that. Then seed round, they were looking for product market fit. They were starting with 150K ARR, and they were trying to get to 1.5 to 2 million. And they were raising 2 million to do that. And then their round A, which is coming up in January, they're going to raise something like 5 to 10 million. And that's to get them to say, 5 or 10 million in ARR. So those are the kind of milestones, and each step of the way, they're kind of de-risking the assumptions they're making. So what does that look like? So I'm basically going to go over the numbers in a way that you have some pages that you can put in your slide deck. No need to look at the detail of these. I'll cover each of them, but this is kind of how what we're going to cover in this session could look like. So the simplest way to look at and think about your numbers is if you think to, say, Dragon's Den, and you think about what are the basic questions they're going to ask you. And those basic questions are, how much, they're all questions that you should be able to write down on a piece of paper and calculate, rule of thumb, back of the envelope, whether this business works or not. So how much are you going to sell one unit for? How much does it cost to make that one unit? What are your running costs? So, what are your overheads, for example? How many units do you need to sell to cover those running costs? And how much time and money does it take to get your customers? Those are kind of the basic questions that an angel in Dragon's Den is going to be asking to back of the envelope calculate whether your business is going to work. So we're going to cover units, we're going to cover the costs, and we're going to cover the customers. I think you have another session on market, but basically the way that the investors are going to look at this is, what are your unit economics? What are the margins on those? What are your variable costs? So what costs do you have to put in for each sale you make? What are the costs that you have? So, your team, your salaries, your office, all that stuff. And what is your customer acquisition cost? And how long do you have that customer? As well as, when do you lose them? And then they're also going to say, how big is that market opportunity? And with those things, very quickly, within that half an hour call that I told you about, the VCs are going to have an idea of whether your business works or not, and how much work you're going to need to do to get to a point where they're comfortable with investing. So the more traction you have, the more those numbers are proved. So let's look at those 3 building blocks we're talking about. So so you're going to be using this model either for internal stuff, for external, for fundraising, but also for checking your business model. And each of you is going to have a different business model. There are 9 basic business models in tech, at least. And we're going to go through some examples for each one. There is a great Y Combinator video that I would love each of you to watch as you're figuring out your numbers, because it will explain to you the best metrics. I'll share a link with that a bit later. But I'm going to give you the basics first, right? So these are the basic building blocks. So your unit costs, your burn rate or your overheads, your break even, and your customer acquisition costs. And again, with those things, you're going to be able to basically figure out whether your business works or not. Now, so your unit costs. This is kind of, if you have a pen and paper ready, or you want to do this on PowerPoint as we go along, this is going to be one of your slides in your slide deck. And that is, what does a unit make for you? So let's say that I heard swimwear earlier. So swimwear, let's say you sell 1 unit of that. So that's 1 item. There's a price for that item, say £100. Equally, if you're a SaaS business, you might be selling a seat per month, for example. Or if you're an enterprise business, you might be selling a contract per year. And if you're a marketplace, you might be selling you might be doing transactions, for example, if you're a payment service, something like that. So it really depends on what you're selling. but you know what your price is. Then you're going to figure out how much it costs to deliver that item, right? What is your COGS? COGS means cost of goods sold. Or if you're a software business, what is your cost of delivery, right? So for example, if you're a SaaS business, you'll have a platform cost because you may be paying per user. You may be paying server costs to Amazon, for example. If you are, again, if you're a SaaS business, you might have a customer service cost attached to each customer that you know you'll have to deliver. If you're doing swimwear, your cost of goods sold, as you well know, are your costs of manufacturing, your costs of shipping, your costs of warehousing. All those costs you need to take into account before you can then figure out, number 3, your gross profit, your gross margin. So again, if you think back to the dragons in Dragon's Den, they're going to say, your product looks great. How much does it cost to make one unit? How much do you sell the unit for? Great. Now I know how much gross profit, gross margin we have to play with. Okay, so that's kind of your very, very basics. And I would actually advise to have this slide, whether it's in your slide deck or not, have it back pocket, let's say in appendix, so that you know exactly what your unit costs are and you can discuss that with an investor. So that's step 1, your unit costs. Step 2, you're going to have to figure out what your burn rate is, what your overheads are, right? So at your stage of the business, the vast majority of your running costs are going to be your salaries. You may have 2-3 co-founders. You all need to pay the rent. You all need to eat. You need to get paid. You will have, as a second part of this, it's also a salary, but it's slightly, considered slightly differently, or I would break it out if I were showing it, is your cost of development if you're a software business. So how much does it cost in terms of developers to get your product to the next milestone? And in each round, so seed, pre-seed, round A, that's going to be a different milestone. So your product is going to look very different in round A than it is in your pre-seed, where it's basically a proof of concept. So how much money do I need to raise to get it to that milestone? That's key in your fundraise. And then what are the other overheads and the fixed costs that you're going to have? Your office, your legal costs, your accounting software, all that wonderful stuff, which we usually forget about and we usually underestimate. So dump a bunch of that stuff in. You're going to say, well, I only have, legal costs at incorporation. No. You are going to have ongoing legal costs. You're going to have ongoing accounting costs. For example, your contracts are going to get tweaked. So put all this stuff in. You then have basically add it all together, let's say for the year. And that's your burn rate over the year. And you can then calculate how long it takes me to get to the point I want to get. Maybe that's 2 years. And you know how much you're burning through every year and every month. So that's a really important number to have for investors as well, right? So that's part 2, know how much you're spending to get to your next milestone. Now, you're also, as a business, gonna have to spend money to acquire customers. At the early stages, you may not be spending like actual money per advertising, but you may have a marketing person that's trying to get you to a number of, to sell your goods. So what we're doing here is we need to figure out rule of thumb. This is not necessarily what the investors are looking for, but this is for you internally. Rule of thumb, how many of these units, how many of what you're selling do you need to sell to make sure, in the worst case, if you can't raise money, that you're breaking even? It's a really, really important number to have, because it's good for you internally to know, like, this is my target. If I hit this number, I am high and dry. And in fact, I could not raise money again from investors and will still be able to continue. So it's a kind of nice magic number. So have that. And the way you calculate that is to say, my burn rate is 120K per year. My gross profit on each, let's say, swimwear unit is £30 out of 100. So to cover my costs for the year, I need to sell 4,000 units, right? So I need to sell 4,000 units to make sure we're high and dry. So that's a really important benchmark to have, right? So once you have that, now we're talking about how much do you need to raise in order to achieve that target, right? So how much marketing or advertising spend do you need to do to get to your break even? Because you're going to need to have that as you know, available money to spend to hit your break even. This is going to be, you know, this is the amount of money you need to hit that first milestone of break even, let's say. And you're going to grow in several different ways. Organic growth is basically by not spending anything on ads. So that might be putting out unpaid marketing, you know, your Instagram channel, your TikTok, whatever it may be. And you're going to have people doing that in-house or externally for you. In-house, you know, probably early stages, you're going to be doing that yourselves. But there's a cost to that. And you can figure out roughly, you know, how much it costs me or how much time it takes me to get a customer. At this stage, you probably don't want to be doing paid growth because you don't have the money to do that. You might be doing that in the next stage. But here again, the metrics are, how much does it cost me to put let's say, an Instagram ad? What's my conversion rate on that ad? And as a result, then I know how much it costs me to get one customer. So let's say I have to you know, advertise to 10,000 people before one of them buys my product. Well, you know, there's a cost attached to those 10,000. And now I know roughly that I have to spend, if 10,000, you know, views cost me, say, £1,000, then I know one customer costs me £1,000 to acquire, if it's 1 in 1,000. That's a crazy number. It's not that's not an actual number, but that's the way to think about it. You also need to think about your customer lifetime. So how long are you going to have your customers? Once they know about you, or once they've subscribed, or once they have signed one contract with you, how long do you expect to keep them? Because if you are acquiring a customer and they buy one thing from you and they never buy again, you're going to have to spend a lot of money on advertising in order to keep your sales up and to grow your sales. So that's another thing that investors are going to ask you, and they're going to say, what's your customer lifetime value? Right? So if you have those numbers, and if you can figure out roughly how much is my customer acquisition cost, then you can figure out how much money do I need to raise in this round to achieve that milestone that I was targeting. In this case, we're saying break even is your milestone. So you can kind of figure out, if I need to sell, let's say 4,000 units, and it costs me £20 to acquire a customer, then I need about 100,000, in this case, you know, £80,000 to get to that milestone. So you kind of have a rough idea of your raise, right? So all this stuff links together. So coming back to that full picture, I know I've flown through it, but this is kind of the idea, is that you can do it with slides, you can do it without a slide, you can do it with, like a blindfold on, your numbers so well that when an investor says, look, what are your unit economics? You can say, this is how much we make per unit. This is how much I'm spending per month and per year. This is how many units I need to sell to break even or to achieve my next milestone. And then this is how much it's costing me to acquire my customers. I've called this the reverse P&L because in, the normal way to do this, if you do it with an accountant, is that they're going to do a really complicated spreadsheet and do your profit and loss statement and do it line by line and figure it all out. But if you have these metrics, you're just working backwards from what's the target number of sales that I want to get to for my break even, and I'm working backwards, and this is kind of the metrics I need to get there, right? So that's the big picture. I'm going to very, very quickly go through some examples and then open up to Q&A so that we can go through everyone's business models. These are some of the typical business models that you'll see in software. Enterprise is basically where you are selling to a large corporate. You might have a contract that runs for a year. You might have a contract that runs for 5 years, or you might deliver one project. You have to know your economics on each project. SaaS business, you're going to be selling kind of monthly or yearly subscription. You might sell usage-based. So let's look at one of these models. Before I look at the kind of metrics for each one, definitely all of you, I recommend to watch the video by Anu Hariharan. I hope I'm saying it correctly. At the Y Combinator Startup School kind of library. And she gives you the metrics that you need to track for each business model. And we're going to go through some of those really quickly. So what does it look like for a subscription model, for example? So I order Oddbox to my house. Oddbox is a subscription model where I get wonky vegetables that have been rejected by supermarkets. So it's a box that arrives every week. And in that cardboard box, you have vegetables that cost the business probably somewhere like, they're making a 30% margin. Once you include the delivery, once you include the warehousing, the sorting, all that stuff, they're probably making somewhere between a 10 to 30% margin on those, tangible goods. It's very different from a software business, but tangible goods. Their costs are the cost of the product, the logistics, the shipping, and they also have a business to run. So on the burn rate side, they've got their salaries, they've got their developer costs because they are running a software business in the sense that I'm subscribing and there's an app. And there's other overheads as well, like their accounting and all that stuff. Their break even depends on that margin, but they'll back solve it based on these metrics on the left. And then their customer acquisition costs, they're acquiring customers by paid ads at the moment, but they're past round A, I think. And so they have probably figured out really clear metrics for that. At the beginning, it was probably word of mouth marketing, trying to get people to sign up. So it was the cost of their marketing person. And they could have figured out on day one, we need to fundraise enough money to have a marketing person that can generate organic growth for a year to get this many customers in. So let's look at one other one. So a SaaS business, you might be using Xero, for example, for your accounting. A SaaS business, you're probably going to be targeting something like a 70 to 80% gross margin. Because on a SaaS business, you're not really adding any costs per unit. You build the software once, and then you can, in theory, sell it as many times as you want. Now, in practice, that's not totally true because each user will have additional platform costs, like server costs, for example, customer service costs. So those are variable costs that you have to add to each customer. And then obviously they have their burn rate is their salaries and their dev costs, their marketing, and their other overheads. And again, customer acquisition as a software business, probably for them it was word of mouth to begin with, paid ads at some point. They probably have referral schemes as well with accountants. So you need to hire someone to pick up the phone to accountants and make deals with them, for example. Those are all in your customer acquisition costs. Let's look at one other one, and then I'll hand over to the floor. So you may know the app Vivino, or hopefully some of you have seen a company called We Are Eves. If you haven't, I'm going to do a little bit of free advertising for them. They are awesome. They are basically the Vivino of beauty and health products. And so they have a community of people that are reviewing beauty products. Two female founders in the Netherlands. They're awesome. I haven't met such a good team for a while. Basically, they have a really interesting model because they are a community-based business. And so they have, last time I spoke to them, something like 100,000 people on the platform. They're not making any money off the people that are on the platform, off the community. So how do they make money? Well, their business model is to sell insights to the big brands like L'Oreal, like let's say L'Oreal is trying to figure out what actually do people want, and they can see that through their data. So extracting that data and telling L'Oreal, this is what people are looking for at the moment, doesn't cost them much money, but it costs them a heck of a lot of money to build a community. So a huge part of their cost and their burn rate is community. They have low cost of delivery, and their customer acquisition cost at the moment is pretty much zero because it's all going through referrals, because in-app people are able to get good deals by referring to other people. And so they're growing like crazy without spending on marketing. So that gives you a picture of maybe an enterprise or a community business. So I just wanted to highlight a few of those business models. I know I have completely flown through that, so I'm sorry if I've fried anyone's brain. And I'll now slow it down and try and answer whatever questions that you have. We can dial it up, dial it down, however you want. Just jump in with the questions.
That was so informative. You're getting a lot of love in the Zoom chat for this presentation, so thank you. We will start off with the first question from Haley. In a situation where your focus is growth and scale first, and you don't plan to monetize immediately, do you indicate potential unit economics for the future?
Yes, you do. So if I'm reading between the lines on that question, that could be a similar business to kind of We Are Eves or Vivino, which we talked about, which is trying to build a community after, and after you've built that, you monetize. Now, you don't have to be as, let's say, clear or as validated on your customer acquisition costs and your unit costs at this early stage, because investors will see the value in building a community. What you do have to show is two things, I would say. One is it's more important than ever for you to show the traction that you have with that community. Because if you have traction and if people are signing up like crazy, then even if you haven't figured out your business model and your unit economics, an investor is going to see, okay, that community, those users, you could probably monetize even if we haven't figured out a way quite yet. So it's really, really important for you to, number one, show that traction and how you're growing the community. Number two, I would say you should have a rough idea of what your business model might be. And you can say, look, we're growing the community. This is how fast we're growing. This is what we're doing to grow it. And we believe that the business model will be X, Y, Z. And we're going to start validating that in phase 2 by doing this. And we might, you need to do some sort of experiments and get some feedback from your users that they're willing to pay for something. So that would be my recommendations there. Is you don't need to show exactly like, you know, this is how much we sell to L'Oreal a project for, but we know that we can sell to L'Oreal, and we know that, for example, Vivino is doing something similar in a different space, and this is their model. That's where we're going.
Just got a quick question that came up at the beginning. So sometimes it's easy to understand what a unit is. If you're selling a physical product, it's probably a bit easier. But for those that have a tech product, yeah, how can they work out what a unit actually means? And I'm just wondering whether if everyone in the chat can put down what they think the unit is on their business. And then Marc, maybe you can just cross-check and see whether people are saying what you would expect to see as, yeah, what a unit might be.
Yeah, cool. 1 second, let me unshare so that I can see the chat. Oops. Okay. Cool. So what is a unit? It really depends for each of those business models we talked about. So if you're, let's go through a few of them, right? So on a SaaS business, I think a lot of you will have SaaS businesses. The unit there is going to be whatever your subscription and your subscription cadence is. I'll give you one example. We worked with a company called Magnid. Magnid does virtual events, and it sells to big enterprises like the Abbott Healthcares of the world. They have kind of two paid models. And just to answer the question, what is SaaS? I'm talking about a software as a service business that sells kind of a subscription to their customers. So for Magnid, it was either a monthly subscription to be able to host events on their platforms, or it was an annual subscription. The monthly subscription costs, say, £5,000, and the annual subscription costs 40,000. So those are two of their units, and those have different costs associated with them. For Xero accounting software, for example, that's Xero with an X. There, your subscription or your unit is your annual or your monthly subscription. And so your unit for Xero, you'd be looking at, say, my customer usually buys for 1 year, and this is how much they pay for that annual subscription. So that's on a SaaS business. Let's think about some other models, right? Maybe 1 second, let me go in the chat. So I sell over 15, sorry, I'm gonna jump because I'm coming to the chat late. I'm gonna jump between some of the comments, but I sell over 15 products. I go for average unit revenue, yes. So if you're selling kind of tangible goods and you have lots of different SKUs or lots of different units, then I would indeed go for an average across those, or what are your best sellers, and nail your best seller numbers. And the peripheral ones, don't think about too much and focus on the best sellers. In a marketplace, indeed, your unit cost, your unit like economics is going to be, you know, let's say you're a marketplace for wine. And so your unit is probably going to be, my average customer buys, you know, a crate of wine once per month. And so that's a unit, and that's a sale. And so that's kind of what, yeah, your transaction. For aggregators or for marketplace, two-sided. So what else do we have? Two-sided platform. Two-sided platform, yes. So you would have subscriptions there. Yeah. Should I continue going through all the business models and try and define the units for each one?
Just wondering whether anybody wants to like go through their actual business model live with Marc now. Raise your hand if you do. Sarah, I know you've got your hand raised anyway about another question, and we will definitely come to you. But yeah, Chrissy, you're the first hand to be raised. So do you want to just go through it live and then we'll see where we get to?
Yes. So what we began with was having a subscription, because we have, well, let me say what the business is. It's a reg fintech that has two offerings. And the first offering is offering compliance as a platform. So it's like a type of CRM for compliance. It's aimed to the payment and financial institutions who want to digitize and streamline the compliance. And it offers third-party KYC, KYB, and AML. AML means anti-money laundering checks, so adverse media and so on. And what we did is actually tranche it. So we had like a subscription fee depending on the users. And then we offer our unique proposition. So we have a transaction fee. So for any transaction these clients do or payment, we offer a fee for delivering a certain service, combining data together. And then because we offer a third-party service provider, the third-party service providers KYC, know your customer, know your business checks, we offer that a fee per check. So it's subscription plus a transaction fee plus per check.
Okay. Okay, cool. Thank you, Chrissy, for sharing that. That sounds like a really interesting business and very much needed, I think. As the compliance officer for Charcot Capital, I know that I spend a lot of time in Excel spreadsheets and Dropbox and stuff like that. It sounds to me as if indeed you have different models, right? So I think for you, you could almost turn it around and say, let's look at a customer as a unit in a way. And I would start with a customer for you, because I think what you're saying is, look, we have a platform which we onboard an average customer onto. That customer pays whatever it is, say £10,000 a year to be on our platform. That gives some basic services. The customer usually then also, does the compliance, has some transactions, but they usually do 1 or 2 transactions per year. So let's say they do 1 transaction per year, and then they do a kind of fee check, or they do, 10 fee checks per year. So I would spec out what your customer's behavior is and say, look, this is a typical customer. This is what they typically spend. And this is kind of our unit economics on each of those layers of spend. Does that make sense? So, where they're spending with us 10K for the platform, £2,000 per transaction, and, £1,000 per check. So it adds up to X per year.
Yes, I think that's where I would ultimately like to go to, like have packages and have like subscription fees, and it gives you this and this and that. But we're still figuring out the volume. So these customers wouldn't do like 2 transactions; they would do thousands of transactions. So if I risk and say a number, and they do so many transactions, I would lose on revenue. And again, it's hard to specify how many KYC checks they would do, because these customers on board maybe a few hundred per month, or some maybe just on board 20 a month. And I haven't got to and the market is changing. So my profiles, I'm discovering a new profile of potential customer. So it's that's where I would like to go, but I decided to like do everything per unit, like not per unit, like per transaction. This is why it's
okay. So I think we're also getting into, let's say, the things that you need to, there's a difference between where you are today and where you need to get to for the investor. So my answer is basically, and where you're trying to get to, is the slide that you have to design, even if you don't have the exact numbers today. And the things that you're talking about, how many transactions, how many KYCs people do, that's exactly the things that over the next few weeks, hopefully by the end of Overrules, you'll have validated, or you'll be on your way to validating. And so your slide is just going to keep changing as you go along. So make your assumptions now, because otherwise you can't figure out your business model. And then change the numbers as you go along. And you might put in 1,000 KYCs per year. That's my assumption based on, I'm an expert in this field, or that's my first customer interviews told me that. And then, the next 5 customers you speak to might blow that assumption out of the water, and you might end up with a totally different assumption there. And so that's also your investor is looking for you to validate those numbers. But if you don't have them, you can't figure out if this business model makes sense. So make the assumptions, then validate.
We've got a question from Sarah, which I think is going to end up with being a bit of a similar thing. So we can go through it live and work through Sarah's business model as well. And then we'll move on to some more questions from there.
Great. Thank you. Yeah, sort of similar. We are going to have kind of a blended business model. I just saw somebody else put a question that might answer both. So we are going to be doing, it's a platform, two-sided platform, onboarding conscious consumers and connecting them to businesses, purpose-led businesses with physical spaces like restaurants, cafes that are eco-ethical. Mm-hmm. So one of the main revenue opportunities is business subscriptions, but we have to onboard a lot of consumers to show the benefit to the businesses. So we'll have a cost of onboarding consumers, but we're not making money from them, at least not until later on. So business subscription being a primary business model, but then also things like data, ad sales, potentially selling the API of good businesses for like white labeling and things like that. So we're looking at quite a lot of revenue models that we want to test as we go along. So it's we get different answers from people that are like, oh, just focus on the one thing and tell the investors about that. But we want to show that the business subscription might be quite difficult to prove for a while, because we have to show them the value of having enough consumers. And we want to show that we have a plan to diversify and reduce risk and really show that we've got lots of options. So any advice on how we kind of simplify that in the short term would be really helpful.
Yeah. Okay, cool. No, I think it's a good question. And by the way, awesome earrings. Very
Thank
cool.
you.
I think the answer to that, maybe coming back to the We Are Eve's sort of model. They knew from day one that if there are no customers that want to buy this or want to not buy this, if there are no customers that care about exchanging like user reviews on beauty products, that they'll never have any type of business. So they always knew that sort of chapter 1, and you can present it to investors in sort of chapters or let's say chapters. You say chapter 1, we know that there's a customer that wants to do conscious consuming. Our first product is really to serve that customer. We know that we have to get to revenue and profitability at some point, but our first milestone is to prove that the customer wants that. So that's what we're raising, say, 200K for. Our business model in future, we know that if there is a customer, that there is a business model here, because once we're at 100K users, for example, we know that we can monetize that. We can monetize that in several different ways. And you're going to present it as if you have looked at different business models and said, we understand what a community, kind of community-driven business, how that works. We've looked at the different benchmarks, and we know that Vivino does this. We know that We Are Eves does this. We know that whatever does this. Our best guess at the moment is that we are going towards this business model. And what I'd really like you to do is to say, we've also had early conversations with the first, let's say, restaurants or whatever it is, that have told us that if we can get users on this platform, this is the type of data that they really want from us, or this is the question they want us to answer. And so that's how you're validating your assumptions, but you're being really honest, saying, we know we haven't validated them yet, but this is our best guess, and we know exactly what we need to do to validate. Does that help?
That's extremely helpful. Thank you. That's great.
Great. So we've got some other questions. So rather than going through anyone's business model live to get to the unit, can you remove your hand if that was your question, and just keep your hand raised if you have a different question that you want to ask Marc. And just remember, start with "my question is," and then 1 to 2 sentences, and Marc can ask for any additional clarity if required. Kofo. You take yourself off mute.
Oh, hello, hi, my name's Kofo. I'm a co-founder of Nazea Health. And basically it's a two-sided marketplace. Currently we've been targeting, it's a two-sided marketplace focused on prevention of lifestyle diseases such as obesity, type 2 diabetes, heart disease. We've interviewed about 60 odd people. 6 of them have been enterprises, heads of health and wellbeing, or heads of HR. In terms of what our business model is, essentially what we plan to do is onboard companies and charge them approximately, say, £50 per employee to actually use the application. We also, on the other side of the business model, will be healthcare practitioners. So there'll be nutritionists, dietitians, doctors, etc. Lifestyle coaches, and we want to charge them a commission on every transaction. So that's essentially what the business model is. So far we've interviewed about 6 enterprises, and we've got positive feedback from the majority of them. One of the enterprises wanted us to send a proposal to, which we did. Essentially what she said, she wants to see an actual product before she will take the next step. One of the other companies that we spoke to, he is thinking about possibly working with us. We need to send a pilot test to that particular organization. In terms of the organizations, there are 5 construction and 1 legal firm. 3 of these organizations have said that they want to attend workshops to get a better understanding of the problem or challenge that we're trying to solve. So in terms of what my question is, one of them is around the unit cost. And I think the unit cost, what I think it is the number of employees that we onboard. So the cost per, the fee that we charge per employee, but I'd like to hear your answer with regards to that. Okay, and the second is around putting in place a pilot test. At the moment, I've basically been just looking online to put together something like that. But I'd be grateful to if you have a background in that, if you could give some pointers with regards to that, because that's the next stage that we're at. Okay,
cool. Thank you very much, Kofo, for sharing that. And I think what the line broke up a little bit, so I missed small bits and pieces, but I got the gist of it. And I think what you're trying to solve on the lifestyle diseases and the chronic diseases is so important. It's something I feel really strongly about as well. So awesome what you're doing. On the unit cost, and the business model, I'm thinking out loud here, but I'm going to give you sort of a quick feedback, which is that I think in the early stages of a platform, it is really, really hard to charge customers from day one. So the direct users. So direct to consumer kind of fees, I think it's really hard. So charging someone £50 to be on your platform, so for the users, you may have validated that, in which case amazing. But I would say that for me is the one that rings some alarm bells like, ooh, that's going to be a tough one, I think. And so...
Can I just say something? This will be paid through the wellness budgets of the company. So the employees themselves aren't paying for it. It will be paid through the wellness budget of the actual organization itself. So the employees won't be paying any money at all.
Got it. Okay, that makes a lot of sense. Perfect. Thanks for the follow-up explanation. So I think in that case, I would focus on the thing that is going to kind of get the most traction the most quickly. And to me, actually, now that you've explained that, selling kind of seats to enterprises is probably an easier sell than making referrals from the businesses. And so I think that's where I would focus again, like the last explanation I made. I would make the story something like this, where I would say, look, this is the problem we're solving. This is the customers on the one hand and the suppliers on the other that we have. We believe that the business model is going to be, the £50 per employee seat business model. We think that's how we're going to get the most traction. This is how we're validating it at the moment. In future, chapter 2, once we have onboarded this many customers, we know that we can also get referral fees from healthcare providers. But that's chapter 2 of this business, because we're getting traction on the employee fees first. And then to answer your question, and so the unit there, it's either a company, so your average small to medium enterprise or your average large enterprise will buy 10 seats or 50 seats on your platform. So that could be your unit. Or it's individual employees, if you think that individuals might be buying this. Because when you're acquiring a customer, you're acquiring a business, right? And not an individual customer. So kind of average out how much the average business is going to buy from you. And that's probably 10 employees or whatever it may be. So that's on the units. I hope that answers that. And then the pilot, how to run a pilot. I think one thing you noticed, you mentioned, is that you have someone saying they want to see a product before they buy. I think what I would do is use that as an opportunity to try and do an informal pilot. And what you could do is completely fake your proof of concept, where you turn up with, you say to them, look, we're building the product. Let us show you the wireframe for that product. This is how it works. This is what we're building. What would you tweak or what would you change? And at the end of that meeting, you say, can I have an MOU that says, can you sign a piece of paper that says, if you build this, I will buy it from you. Like that's how you do your early pilots. And then once you have a product, then you sign that same company up to do a formal pilot on your product. And you probably don't charge them, but you say, look, I'm going to let your employees loose on this. I'm going to give it to you free for 3 months. And that's how we're going to pilot, for example.
There's another, there's loads more questions actually, but we've only got a minute left. Just as an FYI, so we've got Richard Howard coming in on Thursday, who is an angel investor and knows everything about unit economics as well. So if there were any questions about how much validation investors like to see when you're talking about unit economics, that's a great question for Richard. So I'm just going to leave that for now, and then jump to the last questions that we've got in the chat. So again, if you've got a question that's not just running through the unit economics, cool. So is it Kayulat? Sorry if I pronounce your name wrong. Let me know how to
Hi, I'm Kawat. Yeah, and my question is very short. I was going to ask if it's okay to pitch with the least amount possible. So for example, if you're looking to raise like 100,000 euros, and then you're able to show the investor that, okay, we have 4 revenue generators, but looking at our 2 major revenue generators and the least amount possible, like say, oh, if we charge each client like $10 for this product, which is the least amount possible, because we haven't yet decided on the exact amount we want to place on it, and we say that, okay, by the end of the year we will be able to raise, we'll be able to like generate a revenue of around 150,000 euros. Like, do you think that's a good pitch?
Carla, thank you for the question. I think let me try and rephrase it so I'm understanding it properly. I think the question is around what's my price, and can I raise prices over time, right?
No, it's around okay, I'm currently okay, let me just describe the product real quick. It's a sort of HR product where we're trying to connect tech talents to companies. So there are 2 major SaaS products. That's on the customer side, which are the tech talents trying to get jobs, and then the companies looking to get the talent. So what we do is sort of like get this clients and like train them, sort of prepare them to be great matches for the job, and then we place them in jobs. So from the talent side, we're generating revenue. From the company's side, we're generating revenue because they would also be paying to like put their jobs, host their jobs on our job board. So the question now is, we have not set a fee for both of these things, and we're just like assuming that, okay, looking at the least amount possible, which is not the actual amount. If we have like let's say at least 50 people that sign up within the final launch of this product, we are going to get this amount, which is sort of like times 2 the amount we're raising. Like, does that sound like a good pitch?
Got it. I think I get it. It's okay. So I think how I would structure that story, I think, is to say, look, phase 1 of what we've been doing is we just want to prove that there's a market on both sides and that we're solving a problem. We have done that with our first 50 job seekers, and we've placed them, and we didn't make any money off that, but we know that our next milestone is to start generating revenue. This is how much we would intend to raise the price to, and this is how much we charge on the company side. And then phase 3 is, if that works, then we know that we have a viable business, and we believe that we can improve the service and kind of increase the value. So our prices in 1 or 2 years' time, when we've hit each of those customer milestones, is going to be a much higher price than it is today, and it's going to be somewhere around this. And again, you need to validate that by saying, we've looked at other businesses in this space. We know how much they charge. We know in our space how much people pay for this kind of thing. So this is the benchmark that we're going towards. And if you know that benchmark, then even if you're not charging anything today, you sound like a credible founder who's done their research and knows kind of the target to what you want to get to. So really use, I think in your case, figure out what other companies in the space are charging and say that's the target for where we want to go.
Yeah, thank you very much.
You're welcome.
Perfect. So I think that's all we've got time for today. A reminder again that Thursday, we're going to do this all over again anyway, but with an angel investor who's going to be talking about what he looks for and what's kind of expected from their side of the table. So we will send you the recording to rewatch later on today or very first thing tomorrow morning for both Anthony's session and Marc's session. Marc, if people want to get in touch with you, we don't have one-to-one office hours with you, but is there a way that people can reach out to you if they've got any questions?
Yeah, by all means. So I would say number one is just find me on LinkedIn. So I'm Marc Vandenberg, and then if you put Skills Gym in, you'll find me. So just feel free to connect. And number two, I think usually what happens if I give a question like this is that people realize afterward that I said something silly or made a mistake or said something silly. So what I will do is maybe I can offer on Friday or something like that, another hour for anyone that has questions, and we can just try and answer questions then.
Great, that would be awesome. We can email through details of how to join that session. We'll organize it with Marc, and then we'll put it on that same spreadsheet that the C Legals one-to-ones are on. So we will give that to you. Do join the WhatsApp group. Gigi, can you just post the link up to the WhatsApp group again for anyone that hasn't joined, because we post links on the WhatsApp group for the office hour sessions and to join these last minute sessions and stuff. Marc, thank you so much for coming and sharing that information. Seems like it went down really well.
Great, and good luck to everyone.
Thank you, and see you on Thursday for everyone else.